Hello students, welcome to the lecture on final accounts, and after the lecture we will be able to learn the following objectives. Describe the meaning of final accounts, explain the final accounts of not-for-profit organizations, describe the income and expenditure account, explain the balance sheet, define the accounts from incomplete records. Let us start with a brief introduction. All business transactions are first recorded in journal or subsidiary books. They are transferred to ledger and balanced it. The main objective of keeping the books of accounts is to ascertain the profit or loss of business and to assess the financial position of the business at the end of the year. The object is better served if the businessman first satisfies himself that the accounts written up during the year are correct or at least arithmetically accurate. When the transactions are recorded under double entry system, there is a credit for every debit. When one account is debited, another account is credited with equal amount. If a statement is prepared with debit balances on one side and credit balances on the other side, the totals of the two sides will be equal. Such a statement is called trial balance. The main objective of an accounting system is to reveal the results and financial position of the business. With this objective in view, every trader will prepare accounts at the end of each year. Such accounts which are prepared to know the profit or loss and the financial position are known as final accounts. Final accounts can also be prepared in between two accounting years, in which case it is called as interim final accounts. These accounts are called as final accounts as these constitute the ultimate accounts of the business. Preparation of final accounts is the last step involved under the accounting cycle. The final accounts of a trading concern involve preparation of two statements known as income statement and position statement. The income statement shows the details of incomes and expenditures and the profit earned or loss suffered by the business. The income statement of a trading concern consists of trading account, profit and loss account. In case of manufacturing concerns, it also includes preparation of manufacturing account in addition to the accounts. The position statement, also known as balance sheet, discloses the financial position of the business. The preparation of final accounts depends upon the nature of the business. In a manufacturing concern, all the four accounts are prepared, whereas in a trading concern, only the first mentioned three accounts are prepared. In service rendering organizations like banking and insurance companies, the final accounts will include only two accounts, viz. Profit and loss account and balance sheet.
You must know the features of final accounts. Actually, final accounts are always prepared on the basis of trial balance. Trial balance is the list of closing balances of different accounts. And final accounts are sometimes called financial statements. Actually, financial statements or final accounts take us to the profit position or loss position of the company, means what the company has made profit or suffered loss during the year. And secondly, final accounts take us to the financial position of the company at the end of the year. Balance sheet always tells us about the financial position of the company. What is financial position of the company? Financial position means the position of assets and liabilities. So, final accounts will be having two parts. Number one, income statement. Number two, balance sheet. Income statement will tell us about the amount of profit made by the company during the year, and balance sheet will tell us about the position of assets and liabilities. You have already learnt about the balance sheet in our previous segments. And before I start final accounts, you must be aware about the types of expenses. Now you are familiar with the expenses like wages, salary, fuel, carries inward, carries outward, bad debts, loss by fire, loss by theft, etc., etc. and we have used these accounts in our previous segments. All these expenses and losses can be categorized into two parts: direct expenses or indirect expenses. Direct expenses are those expenses which are related to, I mean to say directly related to production, and other expenses are called indirect expenses. To make it more convenient, I can say the expenses incurred up to the door of the factory. Suppose you are running some factory, you are publishing books, or you are making bread and biscuits in your factory. All expenses and losses up to the door of factory, when the goods are ready, up to that point, the expenses are direct, and after that, all expenses are indirect. For example, you are paying wages in your factory to the labor. They are direct expenses because the goods are not yet ready. If the goods are ready, means ready to sell, ready to be sold, and after that all expenses are indirect expenses. And let me explain again, all expenses are of two types: direct expenses and indirect expenses. And under the category of indirect expenses, we cover selling and distribution expenses, and number two, financial expenses. Selling expenses, suppose carries outward, you have paid advertisement, the cost of the samples, etc. And financial expenses, suppose you have paid the rent of the office, electricity bill, salary to the staff. And third category is office and administrative expenses, means any expense related to your office or administration. All expenses are indirect expenses. Salary to the staff, electricity of the office, fuel of the cars, manager's salary, rent of the office, etc., etc. So in indirect expenses, we cover selling and distribution, office and administrative, and financial expenses. But in the direct expenses, they are directly related to production, like wages in the factory, fuel. Sometimes we have to use some fuel in the machinery maintenance in the factory. If you are paying power in the factory, means power is always used for the machinery, not for the office. So power is always treated as direct expenses. Carries inward, because when you pay the carry inward, basically you are paying carries on purchases. It means the goods were not yet produced, because I have already told you the expenses incurred after production are called indirect expenses. So carries inward is a direct expense, but carries outward is a indirect expense. One thing more, I have already told you that final accounts will be having two parts: income statement and balance sheet. And income statement will be having two parts: trading account and profit and loss account. So we can say that final accounts are in three parts: trading account, profit and loss account, and balance sheet. Because in final accounts, we don't jump to the net profit directly. We reach net profit via gross profit. In between, we calculate one more stage, and that stage is called gross profit.
Students, what do you understand by the term final accounts? It's quite natural that the businessman is interested in knowing whether his business is running on profit or loss, and also the true financial position of his business. The main aim of bookkeeping is to inform the proprietor about the business, progress, and the financial position at the right time and in the right way. Preparation of final accounts is highly possible only after the preparation of trial balance. The trading and profit and loss account and balance sheet prepared at the end of the year is collectively known as final accounts. It is not proper to call these accounts as final accounts because balance sheet is only a statement but not an account. However, in actual practice, these accounts and statements are together called as final accounts. The final accounts are prepared on the basis of various ledger balances incorporated in the trial balance and other adjustments made at the time of preparation of trial balance. Trading and profit and loss account is prepared to find out profit or loss. Balance sheet is prepared to find out financial position if concerned. Trading and profit and loss account and balance sheet are prepared at the end of the year or at the end of the part, so it is called final account. Revenue account of trading concern is divided into two parts, that is, trading account and profit and loss account. Trading account. Trading refers buying and selling of goods. Trading account shows the result of buying and selling of goods. This account is prepared to find out the difference between the selling prices and the cost price. If the selling price exceeds the cost price, it will bring gross profit. Trading account constitutes the first segment of the income statement. It is an account which is prepared to ascertain the gross profit or loss of the business. It is called as trading account as it reveals the trading result of the business. As in the case of other ledger accounts, it also has two sides, viz. Debit side and credit side. Items appearing in the debit side of trading account are opening stock. Stock on hand at the commencement of the year or period is termed as the opening stock. Purchases. It indicates total purchases, both cash and credit, made during the year. Purchase returns or returns outwards. Purchase returns must be subtracted from the total purchases to get the net purchases. Net purchases will be shown in the trading account. Direct expenses on purchases. Some of the direct expenses are wages. It is also known as productive wages or manufacturing wages, carriage or carriage inwards. Octroi duty. Duty paid on goods for bringing them within municipal limits. Items appearing on the credit side of trading account are sales. Total sales including both cash and credit made during the year. Sales returns or returns inward. Sales returns must be subtracted from the total sales to get net sales. Closing stock. Generally, closing stock does not appear in the trial balance. It appears outside the trial balance. It represents the value of goods at the end of the trading period. Debit side of the trading account. You have opening stock of goods. The stock of goods unsold for the previous year is known as opening stock for the current year. This constitutes the first item on the debit side of the trading account. This may relate to opening stock of raw materials, semi-finished goods or work in progress and finished goods. Purchases of goods. This includes only purchases of goods which are meant for resale. It includes both cash and credit purchases. Usually, the total purchases of goods are recorded in the inner column of the trading account. The purchase returns, that is, goods returned by the trader to the supplier owing to dissatisfaction, are deducted from the total purchases, and net purchases are then extended to outer column of the trading account. The following transactions are to be excluded from treating as purchases. Purchase of assets other than goods which are meant for sale. Goods received on consignment. Receipt of invoice in advance of actual delivery of goods. Direct expenses. Direct expenses refers to all those expenses which are incurred in acquiring the goods and transporting the same to the go down for sales purpose. Direct expenses include the following: wages. Wages are mostly incurred by a manufacturing concern and hence appear in a manufacturing account. When separate manufacturing account is prepared, it is recorded on the debit side of trading account. Sometimes the term wages and salaries are given together as an expense. This is also treated as a direct expense and therefore to be taken as trading item. But if it is worded as salaries and wages, it is to be treated as indirect expense and hence should be taken into the debit side of profit and loss account. Dock charges. It is a charge levied on ships and the goods carried by the ship. Duty. Duty payable by a trader may relate to customs duty, excise duty, and octroi duty. Customs duty is levied on imported goods, whereas excise duty is levied on the goods manufactured within the country. Octroi duty is payable when goods are brought from another state of the same country. The duty payable on purchased goods appears on the debit side of the trading account. Freight, carriage inwards, and cartage inwards. All these refer to transport expenses incurred on purchased goods until they reach the premises of the trader. All expenses incurred in transporting goods are treated as direct expenses and appear on the debit side of the trading account. However, freight, carriage expenses, or cartage paid on purchase of assets should be capitalized by debiting asset account and crediting cash account and not to take into trading accounts. Items appearing on debit side of the profit and loss account. The expenses incurred in a business are divided into two parts, that is, one is direct expenses are recorded in the trading account and another is indirect expenses which are recorded on the debit side of profit and loss account. Indirect expenses are grouped under four heads: selling expenses, all expenses relating to sales such as carriage outwards, traveling expenses, advertising, etc. Office expenses, expenses incurred on running an office such as office salaries, rent, tax, postage, stationery, etc. Maintenance expenses, maintenance expenses of assets. It includes repairs and renewals, depreciation, etc. Financial expenses, interest paid on loan, discount allowed, etc. are few examples for financial expenses. Item appearing on credit side of profit and loss account. Gross profit is appeared on the credit side of the profit and loss account. Also, other gains and incomes of the business are shown on the credit side. Typical of such gains are items such as interest received, rent received, discounts earned, commissions earned. Let's now discuss the final accounts of not-for-profit organizations. There are certain organizations which are set up for providing service to its members and the public in general. Such organizations include clubs, charitable institutions, schools, religious organizations, trade unions, welfare societies, and societies for the promotion of art and culture. These organizations have service as the main objective and not the profit, as is the case of organizations in business. Normally, these organizations do not undertake any business activity and are managed by trustees who are fully accountable to their members and the society for the utilization of the funds raised for meeting the objectives of the organization. Hence, they also have to maintain proper accounts and prepare the financial statement, which takes the form of receipt and payment account, income and expenditure account, and balance sheet. This is also a legal requirement and helps them to keep track of their income and expenditure, the nature of which is different from those of the business organizations. Meaning and characteristic of not-for-profit organization. Not-for-profit organizations refers to the organizations that are for use for the welfare of the society and are set up as charitable institutions which function without any profit motive. The main aim is to provide service to a specific group or the public at large. Normally, they do not manufacture, purchase, or sell goods and may not have credit transactions. Hence, they need not maintain any books of account, as the trading concerns do, and trading and profit and loss and account. The funds raised by such organizations are credited to capital fund or general fund. The major sources of the income usually are subscriptions from the members' donations, grants in aid, income from investments, etc. The main objective of keeping records in such organizations is to meet the statutory requirement and help them in exercising control over utilization of their funds. They also have to prepare the financial statements at the end of each accounting period, usually a financial year, and ascertain their income and expenditure and the financial position and submit them to the statutory authority called Registrar of Societies. The main characteristic of such organizations are formed for providing service to a specific group or public at large, such as education, healthcare, and recreation, sports, and so on, without any consideration of caste, creed, and color. Its sole aim is to provide service either free of cost or at nominal cost and not to earn profit. These are organized as charitable trusts or societies, and subscribers to such organizations are called members. Their affairs are usually managed by a managing executive committee elected by its members, receipt and payment account. It is prepared at the end of the accounting year on the basis of cash receipts and cash payments recorded in the cash book. It simply is a summary of cash and bank transactions under various heads. In other words, this is a summary of the cash book for the period for an organization with no assets other than cash and no liabilities. Hence, the cash book reveals everything about what happened financially during the period. Income and expenditure account. Distinction between income and expenditure account and receipt and payment account based upon discussion made in regard to the receipts and payments account and the income and expenditure account, we make the distinction between income and expenditure account and receipts and payments account.
We are studying the first of the two macro models that we're going to learn. We're looking first at the income expenditure model. That's the model which focuses on the short run. After that, we will, not today, but we will move to the growth model, which is a longer run perspective. All right, now, this model is based on three principles, okay? The first principle you already know. It's a definition. It says total planned expenditure is the sum of C, I, G, and X minus M. Okay? The second one says, and this is really a restatement, that EP can be expressed as a function of GDP. In other words, we can graph it here. Okay? And the third one says, not only is spending a function of income, but income is a function of spending. So we have some reverse causality here, which is interesting. Okay, for now, this is the most important one that we're going to work on. Okay? What we want to know is, what does this relationship look like between GDP or income and spending? Okay, now, it's easy. We take the four graphs that we developed last Monday and we add them together. Okay, I showed you how to do that on Monday. We'll do it in sort of a shorthand way. What does the consumption function look like? Somebody remember?
A linear increasing
Yes. Looks like this, right? What's the vertical intercept? What do we call that? Autonomous consumption. Okay, we said that consumption is autonomous plus induced. Induced means caused by income. The slope of the consumption function is this thing called the marginal propensity to consume. The marginal propensity to consume is a long-winded expression for a simple idea. If you get a raise, if your income changes, how much do you spend? What fraction of a change in your income do you spend? That's what the MPC is. Okay, if you look at the graph and think about rise over run, the rise over run is the change in spending divided by the change in income, and that's the definition of the MPC. You know, you get a $100 raise, what fraction of that $100 do you go out and spend now? That's what it is. Okay, so this is induced consumer spending. This is autonomous consumer spending, caused by something other than income. Okay, like your ability to borrow, your savings, something other than your paycheck. Questions? This is review, so I'm kind of going quickly. Diana, got this? Okay. All right, now, the rest is easy or hard, depending on your perspective. Okay? What we've said is investment depends on interest rates. Investment depends on rate of return. But investment doesn't directly depend on income. And because it doesn't depend on income, there's no relationship. The investment curve is horizontal relative to GDP or income. Karen? Got that? Good, good. Okay? Government spending is given, so it's independent of GDP, and net exports are given, so they are independent of GDP. Okay? This was an assumption, this was an assumption. They're not critical, we can easily adjust those once you get the basic model down. Okay, so this is going to get messy. You may or may not want to draw what I'm going to draw. You may just want to draw what the conclusion is. Okay, we want to add these together. So we start with the consumption function. That's this thing right here. We just draw it on the bigger graph. Okay, then we add in a constant amount of investment. So what happens to the C line? It shifts up the C line, strictly speaking, you're right. But if we're adding a constant amount of investment, then C plus I is C plus the amount of investment. Okay, and it's the same amount here as here because that's a horizontal line. All right, same thing with government spending. When we add G, it just shifts the whole curve up by the amount of government spending, C plus I plus G. So this is government spending, this is investment, and the same thing for net exports. So, any questions about what we did before I erase it and draw a cleaner picture? Dave, you with us?
Yeah, I just thought that that was the finish, so I just drew.
Well, it is the finish, okay, but what I want to do is, that's kind of almost outside the range of my arm reach, so I'm just going to pull it down a little bit.
Okay, cool.
Okay, now a couple of questions. Here, I'm going to erase this just because I need the room. Okay.
The main differences between receipts and payments account and income and expenditure account are: nature. Receipts and payments account is a summary of cash transactions for a period, and it is a real account. Income and expenditure account is a summary of expenditure and income, like trading and profit and loss account, and it is a nominal account. Objective. Receipts and payments account is prepared to show cash and bank receipts and payments during the period to derive closing balance of cash and bank. Income and expenditure account is prepared to show the net result of the operation during the period to derive surplus or deficit. Recording. All cash and check receipts are recorded on debit side of receipts and payment accounts, whereas all cash and bank payments are recorded on credit side. In income and expenditure account, all expenditure of revenue nature are recorded on the debit side, and all incomes of revenue nature are recorded on the credit side. Capital and revenue items. There is no distinction between capital and revenue receipts and payments in receipts and payments account. All expenses and incomes of revenue nature are recorded on accrual basis in income and expenditure account. Contents. Receipts and payments account contain only cash and bank transactions. Income and expenditure account contains both cash and non-cash expenses and incomes of revenue nature. Balance sheet requirement. Receipts and payments account is not required to prepare balance sheet. Income and expenditure account is required to prepare balance sheet. Adjustments. No adjustments are required in receipts and payments account. In income and expenditure account, adjustments are made because it is prepared on accrual basis. Let us now talk about balance sheet. A balance sheet is a statement which portrays the financial position of the business. It is so called because it is a sheet of all ledger balances pertaining to assets and liabilities for a given period of time. Its purpose is to know the exact financial position, that is, solvency or insolvency of a business for a specified time. After the preparations of trial balance and trading and profit and loss account, all nominal accounts get closed. In the ledger, only personal and real accounts will show the balances. In other words, they constitute liabilities and assets. The balance sheet is prepared showing the classified list of such balances. It should be noted that a balance sheet is a position statement and strictly speaking, it is not a part of the double entry ledger account. Therefore, no transfer of the ledger to account balances is necessary. Only the relevant particulars are extracted from the ledger while preparing a balance sheet. Trading account and profit and loss account reveals GP or GL and NP or NL respectively. Besides, the proprietor wants to know the total assets invested in business, to know the position of owner's equity, to know the liabilities of business. The word balance sheet is defined as a statement which sets out the assets and liabilities of a business firm and which serves to ascertain the financial position of the same on any particular date. Objectives of balance sheet. It shows accurate financial position of a firm. It is a gist of various transactions at a given period. It clearly indicates whether the firm has sufficient assets to repay its liabilities. The accuracy of final accounts is verified by this statement. It shows the profit or loss arrived to profit and loss account. Equation of balance sheet. Capital equals to assets minus liabilities. Liabilities equals to assets minus capital. Assets equals to liabilities plus capital. Now in the end, let us summarize what we have learned in this lecture. Profit-seeking entities undertake activities such as manufacturing, trading, banking and insurance to bring financial gain to the owners. Since not-for-profit entities are guided primarily by a service motive, the decisions made by their managers are different from those made by their counterparts in profit-seeking entities. The trading and profit and loss account and balance sheet prepared at the end of the year is collectively known as final accounts. Trading account shows the result of buying and selling of goods. Wages are mostly incurred by a manufacturing concern and hence appear in a manufacturing account.